Yeah, my name is David Zanoni. I work for the Risk Management Agency, and what I'll be talking about in your series here is about crop insurance and how that works with as the weather changes, as climate changes, how farmers use insurance systems to manage their risk in the face of the uncertainty. And I do kind of want to talk about a lot of times when we talk about things like climate change, there gets this confusion of what's climate versus what's weather. And I think it's important to kind of start with just the notion of what crop insurance really is insuring against is weather and that weather variability more than anything else. And so the extent climate drives long-term changes in weather, that becomes more and more significant. And so I want to talk a little bit of kind of how we integrate that over time and how at least the insurance side helps provide risk management solutions to American farmers and ranchers. So I'm going to start, if I can get a slide to change, just a quick little overview for those of you that aren't particularly familiar with the federal crop insurance program. The program does insure natural causes of loss. In particular, it's ensuring yield loss, or actually a production loss. I don't produce as much corn or soy or whatever as I anticipated, or revenue. So imagine price losses or price combined with yield. And we also do things like weather indexes. Basically, if various weather events happen, they can trigger payments that would be correlated to agricultural losses that were natural cause of loss. One of the unique things is it's all sold through the private industry. So we have these things called approved insurance providers, basically insurance companies via private insurance agents. They sell and service all federal crop insurance. And what the government does is essentially we administer the program and underwrite the program through subsidies and reinsurance through these insurance companies. But producers, farmers and ranchers, they will be working with private industries for all their policies. And who bears that risk? Who's taking all this on? Well, it's a shared environment. So the insurance companies take some of that risk on. The U.S. government takes some of that risk on. And private reinsurers take some of that risk on. So as things change and that risk changes over time, it is a shared among both private and public enterprise. This is kind of what I was just saying, that the key thing is just understanding the roles of each side of what the government does and what the insurance companies do. In particular, I'll point out that things like loss adjustment and all the marketing stuff happening on the private side, where we're primarily in the government serving as kind of the developer and reinsurer as a regulator. The basic design for all insurance follows this concept of at the start of season, some expectation is generated. What is my expected yield? And what is my expected price? For a yield, you're typically looking at a 10-year average of your production. There's a bunch of options you can purchase on how to adjust that based on what your true expectation is, and it sets a basis for the year. And then price expectation is entirely kind of commodity markets driven for a vast majority of your row crops, but then there's also forecasts for the smaller crops. And then at the end of the seasons, you see what did you actually produce? Was it less than what you were expected? Was the final market price higher or lower than you expected? And then you're essentially given an indemnity payment, a loss payment, if you basically were worse off than you expected, minus some deductible that you can choose. So that's kind of the basic design. What does that look like over time? You can see this going back to a long time. It used to be a very small program for many decades, and then some legislative changes in the 90s, and then especially around 2000, really caused the program to expand dramatically in terms of overall acres. And then you can see kind of the orange there in the middle in particular, using revenue insurance has become the dominant form of insurance for especially you guys, your neck of the woods there with the corn and soy producers. With that, I have to talk about insurance. I have to talk about what's called actuarial soundness. That's something that's defined in our legislative mandates from Congress. But essentially, what we're looking at is we have to charge a premium that's sufficient to cover anticipated losses, plus a reasonable reserve. So some level of reserve beyond that. But the idea being is we have to look at what we think those natural causes of loss will be, and charge enough to recover that. And so we have to kind of keep an eye on what are those drivers on the weather events that are going to cause loss events. You can see there that our target is about 88%. So a 1.0 or a 100% would be we pay out what we take in. We aim for 88% because that covers the reasonable reserve portion. Then of course there's a subsidy that taxpayers provide to the program, around 60%, 63%, I think is the average there that we have in the slides, in which the government's kind of subsidizing the program. The key thing there is if you set the premium rates too low, that means the government's taking on extra costs, and the taxpayers in particular. If you do too high, the program becomes too expensive, and then participation suffers. Farmers don't manage the risk of the insurance program. But over the time, we've done pretty well. We quote the 0.84 over the last 20 years, which looks pretty good. And over the past several years, the total premium amounts to about $10 billion. So that's kind of the rough value of agricultural risk that the program takes on, is about $10 billion. So if you're looking for an economic impact of what essentially weather risk does to agriculture, at least that's covered within our program. Where is that weather risk? Primarily drought, and then followed basically by rain. That precip / flood / storm category basically is either too little or too much water. It's usually that simple for a vast majority of cases. And how does that kind of correlate over the country? And what I've done here in the next two slides shows you on the right, the drought severity index. You can kind of see where the drought is and isn't compared to losses. And I know the colors can be kind of hard to follow, but you will see that they roughly will go together, especially once you kind of take into account the size of the program in various locations. This is 2016, which was a low loss year. You can see that by the loss ratio of only 0.4. But in 2012, and there was a kind of a historic drought, which those of you up in Minnesota probably are aware you're very close to what that was like about a decade ago. You can see how the losses can get quite high there when you have a heavy drought. So that year was some record losses for us, and so it's a good kind of case study of what weather can do to the agriculture industry and how much money can essentially be lost in the system. Here is just a simple slide just to kind of give you a rough idea of how we do estimates or how that can kind of flow out across the nation. In particular, this is non-irrigated corn. It shows you the rough rate comparison of the country, and you can see what you'd expect. The Corn Belt has kind of the lowest risk, but then as you get to the periphery, risk goes up, and it's because the weather is much more variable. The soil is much more of a lower quality, especially when you get non-irrigated and you're very reliant on that rain to be what you need. And then also throw this up is where soil is also a major impact as well. So and just as a comparison to where that risk sits. And this is just another basically showing the same thing, yields with that same basic data set of how they kind of follow. The high yields tend to be in that same kind of zone. But what I want to get to is this in the next couple slides. So we talked about historic loss ratio and how you kind of calculate it. One of the big things is the program has evolved over the years in terms of how we better understand these various drought events and flood events. And you can kind of see from this graph in the 70s and 80s, we tend to have a lot higher losses. We weren't really capturing that risk very well in a lot of ways, but we also had a lot of events. Whereas in the more recent years, the last 20 years or so, a little bit more than 20 years, we've been much more on target. Now, that doesn't necessarily mean risk has reduced, over that time, but it means the program has evolved and had to adapt. And so I think kind of going with you guys' theme of adaptation and resiliency is kind of what our program has done over the years to be able to kind of adapt to what things look like and how farmers farm and how the climate and how weather has changed. One of the things that we've noticed is we probably were anchoring with data too far back. We used to start with data that goes all the way back to 1975, and that's probably not a good measure of true yield expectations for the modern farmer. And so now we use just a 20-year rolling average for the yield risk. Price risk, like I said, we heavily use commodities markets, which are forward-looking. They're in Chicago and other international markets. And then we do annual updates to our yield data, so we can kind of stay up to date with trends, as well as we're much better at defining high-risk areas. So in particular, flood zones around rivers, we do specialty rates for those areas. A lot more technology is integrated in that, using GIS to identify those areas that are more flood prone, that would have a higher risk than, say, the surrounding countryside. We also regularly review things like program dates. I have a slide kind of coming up in a second to kind of show that as farmer behavior has changed around the country, we have to kind of update where they're planting and when they're planting for the insurance coverage to match that. And ultimately, have our policies reflect the modern producer. As smaller farms get more diversified, often that's a major risk management strategy for smaller farms, providing insurance products that recognize the diversification. Or organic, as our organic has gotten much bigger, we've had to have kind of specialty coverage to make sure organic is properly accounted for in the system. This map is really interesting because all the blue dots shows an increase in corn acreage from basically 1979 to it's a little out of date, but the rough trend will still be true. But you can see the blue dots where acreage has been increasing with U.S. corn over time, and then the red is where it's been decreasing. And you can see these trends, how farmers have been changing based on it's heavily an economically driven decision of where the best places to grow the corn versus other competing crops. But a lot of that's going to be weather driven as well. As climate and weather change, certain areas are going to see a lot of growth. I'm sure
Is David frozen on anybody else's?
Yes.
Yeah, okay. All right, we'll give it a second here.
I'm back. Can you guys hear me?
Yep.
I think I just disconnected me for a second. See if I can share my screen. Chris, I cannot get my screen share back up.
Okay. Participants should be good to go.
Here we go. Here we go.
Okay.
I apologize for that. It just randomly just kicked me out for some reason. That's not like the planting dates for corn.
Yeah.
But anyways, the point being is you can see how varied it can be across the country, and I think Chris showed an excellent slide earlier of those things are going to change as weather patterns change over time, and so we have to adapt so insurance can reflect that. And really, to get to the heart and soul of what all this is about is starting to talk about incentives and what incentives farmers have to produce a good crop, right? Especially in the world of insurance, there's a term called moral hazard, where basically the idea is you're better off if your crop dies than if you grow it, and we don't want that, right? We don't want to encourage lack of production. We want to encourage production with, if something bad happens, we're there to get you through the season. And so there's three main ways that the insurance program really addresses moral hazard. The first being is a deductible, and that's the idea of sharing risk with the producer. And so if the producer loses a crop, we only pay a portion of it back. They have to share some of that loss as well. And so that gives them a strong incentive that the crop's always going to be worth more harvested than as an insurance payment. The other is the actual production history. is because we use a farmer's own historical yield information. If you have a bad year, that goes in your history for the next, and so your amount of insurance you can buy goes down and down and down if you keep doing worse and worse. So we don't let people keep insuring at a artificially high value if they can't produce it. And of course, the last is we do adjust premium rates regularly. So if there's trends and losses, we can reflect that, whether that's bringing rates up or down based on what producers are actually experiencing. And so really that kind of bold point, farmers do have a strong incentive to protect and optimize their crops and to minimize risk overall. This gets a little bit technical, but I think it's an interesting point, and a lot of people don't realize it that think they're fairly familiar with crop insurance. But one of the things that we've noticed over time is that producers that produce higher than average yield tend to be less risky than producers that produce lower than average yields. And so one of the things we do is we set something called a reference yield. That's kind of just a baseline of maybe an average yield at a simplistic level, and then we alter their premium rate based on their actual performance. And so for those producers that take on practices that improve their yield, they'll actually get discounts. They'll actually save money by doing those practices. So one of the big things we've looked at recently is cover crops. Cover crops obviously has a huge conservation benefit, but one of the questions is to the extent that increases your yield or reduces risk, and to the extent we're looking at that more completely, but to the extent that producers can get higher yields because of their smart cover cropping system, they get rate discounts as a result of that. So that's a big thing. So I think there's more to come on those types of things, but I think it's important to point out that producers have control over this, and the better they can get in terms of their yield, they will be better off. I did not pull up a Minnesota example. I apologize, but here's one from down in Illinois. If you're on average land, your yield improves 10% below the county average to 10% above the county average. It can give you a 20% increase, if you go from 10% below the county average to 10% above the county average, obviously gives you a 20% increase in the amount of coverage you have, so how much insurance it would pay and a total loss, but a 17% decrease in premium rate. So you're essentially getting 20% more coverage at 17% or 17% less cost. And so which ends up washing in terms of your overall bill. But again, if your bill stays the same, but you get a larger payment in the event that you do have a loss, there's a huge advantage for those producers that can find ways to drive the yields higher. And of course, with marginal land, it can be even more substantial, where if you can dramatically improve marginal land, it can be a substantial increase in coverage and a substantial decrease in rates. So that's one of the things the program, I think it excels at, is kind of incentivizing producers to improve the quality of the land and not just farm something into oblivion. This is a graph from other departments in the USDA, but I think it's really fascinating to talk about adaptation, in that those green dots are corn yields over time, 1920 to about a couple years ago, 2014. And then those other lines are various technological innovations and their basically their adoption rate. And so that red line is hybrid seeds. When the first hybrid seeds came out in the 1930s, they quickly got incorporated. And then herbicide use, and modern herbicides, 50s, and they got dramatically used. And then the genetically modified seeds, and then you have precision ag is that blue, which is actually much higher now, as I think it's above 80%, last statistics I've seen in terms of tractor guidance, the auto steer technology. All these things have been happening over time, and there's been just a steady rise in corn yield. And no one technology drives the corn yield up, but it's this fact that these farmers are naturally very innovative and adaptive to technology. Kind of shows that. And you can also see this with things like conservation tillage. No-till is becoming more and more popular in large parts of the country. Here's some data from ERS. Here's one for nitrogen use, the variable rate, the VRT, variable rate technology of how you apply nitrogen instead of just one solid application. This is innovation that's driving higher yields and lowering risk. And then I just got a list of other things: high density planting with trellises, rice, intermittent flood. So basically, rice producers don't keep their field completely flooded; it stops and reduce water use. New efficient irrigation methods like drip, cover crops, precision ag, all these things that kind of drive innovation. But you know, many of these will require many years to recoup the investment, and you know, the stability of a system of insurance or anything that can provide financial stability to the producers becomes very important in all this, because obviously as the uncertainty, future uncertainty decreases, the willingness to undertake these major investments increase. And so that's one of the things I'm kind of interested to see. I won't be able to stay today, but I want to watch some of the solar presentations coming on later, because the extent revenue can be derived from other sources, that actually can come back in terms of greater technology use on the farm for other risk reduction things for producers. And so, you know, where crop insurance or any other system helps reduce uncertainty, it can drive this adaptation. And so that's where I want to kind of stop there. And thank you for your time. And it's been a pleasure to talk about crop insurance, and hopefully so kind of help your community get better and learn about options to help support producers.